Hello everyone and welcome to TBS Financial Channel. Today we will be talking about the equity market. And just to be clear from the beginning, and there are people who are confused by the terminology, equity and stocks is pretty much the same thing. There are two synonymous terms. So it's just in the investment management word, we don't use the word stock, we say equity. So when we talk about equity market, we're really talking about the stock market. The first thing that you need to notice and we emphasize on is in the equity market, there are two markets. It's exactly the same thing as we saw it in the bond market. There's a primary market and a secondary market. In the primary market, the only seller of equity are the issuer of the equity themselves, which are corporations. They do that through IPOs, initial public offering, meaning that it's the first time they put their shares on the market. And the secondary market is the market where people buy and sell stocks after they've been issued in the primary market. There are many important exchanges in the world. Probably the famous one, which we call Wall Street, is the New York Stock Exchange. And by the way, in Wall Street we have the New York Stock Exchange, but also we have the NASDAQ, where we trade the, let's say, tech companies. They are both on Wall Street, but there are many other really great places like the London Stock Exchange and other places in Asia and in Europe. When corporations go to the equity market, they're looking to raise funding, and they use this funding to finance their investments, their operations, etc. And comes the big question is, what's the value of these shares when they go to the primary market? We understood from the secondary market that there is a market that people see and they can buy and sell, and there's a market that tells you what's the fair value. But in the primary market, we need to give an indication in the initial public offering, the IPO, what's the value of the firm. And there are many different concepts that we need to address at this point. The first concept in shares value is what we call par of face value. So this is basically the value of shares which is recorded in the books of the company. So this is the face value of the shares. Then there is the issue price, is the price with which the company will issue the prices, which could be different from the face value. It could be higher, so we say there is a share premium, or it could be lower if the company is losing money, etc., etc., and we say that the share is trading at a discount. Now we go back to how can we value these shares, and the first way of valuing is using the book value, which is literally the value of these shares using the balance sheet. What do we see in the balance sheet? And we take this total net asset value divided by the number of shares, and that's the book value. So basically we don't account for future cash flows, something like that. We just see what the company has, we divide that by the number of shares, and that's the book value. That is what we call the market value. The market value is taken from the secondary market. Basically there is a price that people buy and sell, and could be very different from book value. And that's why sometimes we introduce the notion of a ratio is market to book value. So you can have like a share that is trading 2 times the book value, 3 times, 1.5, or sometimes less than its book value when is the company under stress. Then there is the last part, which is the fundamental value. In the fundamental value, we would like to see what's the intrinsic value of the assets. What are these assets are worth, and we divide by the number of shares. To do that, there are different kind of calculation methods, different financial methods that we use to price this. Now, on the fundamental value, we need to pay attention. There are 2 approach and 2 methods. One is called direct approach, and one is called indirect approach. And there are 2 methods. There is what we call intrinsic method, and there is what we call a relative method. So that you understand, when we say intrinsic method, let's take the example that you are buying an apartment. If you buy an apartment, the way how to value the apartment, you can say, okay, how much money I'm gonna get out of this apartment, how much rent I'm gonna get. So that's the intrinsic, how much cash flow I'll get the apartment. Or the other way is you're gonna say, okay, the next door apartment or the next building apartment is worth X amount. My apartment is pretty much the same size or a little bit bigger, and you adjust for the size and you know what's your value. So that's the difference between intrinsic and relative. Now the difference between the 2 approaches because we're looking for the equity value, the direct approach, it tells me what's the money that goes directly to the equity shareholders. The indirect, we value the equity share part by first valuing the firm and then subtracting the debt out of it. So with these two approaches and these two methods, we have basically 4 different valuation methods that are important. Let's start one by one. So the first one is a direct approach, which means the cash that goes to the investors. And it's intrinsic method, so we're not looking to compare with another company. We're saying what's the cash flow that goes directly. So what's the cash flow that goes directly to the shareholders is the dividend. So the method here is based on just summing all the future potential dividends and discounting by a certain interest rate. So this is future dividends that come, and we will out of this we will get the value of the shares. Now, the indirect approach with the intrinsic value, because it's intrinsic, we're still looking for cash flows coming. In this case, we're looking for the cash flow that goes to the firm as a whole and not just to the shareholders. And the cash flow that goes to the firm as a whole is what we call free cash flow. And the method that uses discounting free cash flows to know the value of the firm, and then so we find the value of the firm, then we subtract the value of the debt, and we will find the value of the equity. So the method looks for the value of the firm using free cash flow discounted. It's called DCF, discounted cash flow method, which is probably one of the most popular ones. Now let's go to the relative method and direct. So the relative method, here we're comparing our firm to another firm with multiples, with competitive multiples. So because we're looking to the direct approach, the cash flow that goes to the shareholders is the net income. Okay, so that's the cash flow that goes to the net, and we want to know how much the net income will be multiplied by what figure relatively to a firm that is close to it. So the famous ratio that we will use in this method is called the PE ratio, price earning ratio. So let's take a quick example. If we have a firm that is similar to ours and it has a net income of, let's say, $500,000, and we think that the value of that firm is 5 million, so the multiple is 10, which means that you basically will value this firm's 10 times the yearly net income. So we take that multiple, the 10, and we'll multiply by our net income. So let's suppose our net income is 1 million. Then we multiply the 10 by 1 million and we find 10 million. So the value of our firm using this method, which is the PE ratio, is just multiplying 10 by 1 and it's 10 million. Now, if it's a relative method, but it's indirect, we still use multiples because we're comparing, but we're comparing with not net income, but with EBITDA in general, or EBIT, or anything that goes to the firm. And let me remind you, EBITDA is earning before interest, tax, depreciation, and appreciation. So we will use a multiple of EBITDA as a method. So in a nutshell, we went through the 4 different methods. Through two methods and 2 approaches, which gives us four valuation methods that are very useful to find the fundamental value of the firm. That was a quick overview on the equity market, and see you soon on the TBS Financial channel.